Now, first up, myths tend to thrive in environments of imperfect information. Africa and its financial markets may fall into this category. Despite the continent's increasing middle class, improving economic environment and governance reforms, perceptions about war, a high cost of doing business, corruption, dictatorships and illiteracy persist, scaring off, in many cases, potential investors. Greg Barker, Director of Investment at Sustainable Capital, joins us from Cape Town to elaborate. So my first question, Greg, is whether you have nerves of steel to tread where many are fearful to go.
Well, I think it depends on how you define risk. If you're comfortable that you're buying good quality companies at material discounts to their fair value, counterintuitively, those opportunities often emerge where there are short-term perceptions of socio-political risk, which are often out of touch with the long-term fundamental prospects of the companies. And a country like Egypt in 2012 is a perfect example of that, where we took Egypt up to 34% of our portfolio and had been doing the work on those companies, and that market returned 51% in US dollars over that year. So even though there was quite an acute perception of extreme socio-political risk, there were companies which had competitive advantages that were not linked to the government, they were not linked to political affiliation, they were true economic edge. And those companies are going to be around 10 or 20 years from now, but you were buying them at a small fraction of the replacement cost of their tangible assets.
Greg, I'm interested in how you are gathering your research. You talk about a bottom-up approach when it comes to companies across the continent. I'm assuming then you have a wide Africa network.
Yeah, all of our most valuable research comes from on-the-ground work that we do in-house as a team. So, for example, our team has just returned this weekend from 10 days in Nigeria, where we would have been interviewing the chief executive officers, chief financial officers of the companies, going through the detail, not leaving any stones unturned, so that we understand the downside risk from an investment perspective. And of course, in a lot of those companies, there are above normal and excellent long-term growth prospects. So once you understand, what is in the price, and you've got a margin of safety on your valuation, you can have the conviction that you require to take a big position in that company. But really, you have to be on the ground, kicking the tires, if you like, and actually checking the quality of the assets firsthand. And that is where most of our valuable research comes from.
Let's talk about your flagship fund, and that is the Alpha Africa Fund. It holds between 15 and 25 stocks at any given time. Obviously, I want to drill down into the stocks and where geographically those are located, but perhaps just highlight the overlying philosophy.
The main philosophy is to buy companies that are high quality, but for whatever reason are trading at material discounts to their fair value. So we take a long-term investment approach of 5 to 10 years when analyzing the company. And where we find high quality companies, and that's regardless of country, sector, or we're agnostic to which country that company is in. It could be in any African company, whether it's a steel industry, whether it's hotels, whether it's banks, whether it's cement, it could be a utility company. So from that bottom-up process where we're looking at the companies purely based on valuation, that's what actually drives your model portfolio and the stocks that you invest in and the weight that you have in each stock at the end of the day.
Do you have a geographic bias in the fund at the moment?
No, well, what you'll see is, although we will present to our investors, for example, what the underlying economic exposure is in, say, Kenya, Nigeria, Egypt, Morocco, Zambia, any of the African countries. Those exposures are really just a attribution exercise that we do and are a function of the stock selection process. So we could end up with a very big weighting, to use the same example of Egypt, where it was 34% of portfolio, but now is down below 13% of portfolio. But we don't use that as a starting point. So we wouldn't, for example, say we like Nigeria as a country. It's got 175 million people, great consumer market, and within that we like the infrastructure story. Let's look at some cement companies. We do it exactly the opposite way around. So we're purely looking at the companies, and regardless of what industry they're in, which country they're in, it's a purely valuation-driven decision.
Talk to me a little about the listed environment on the continent. Often we hear investors saying that we're looking at illiquid markets, that it's difficult to get access. Do you believe that that is the status quo and that we should rather potentially go for private equity plays on the continent?
No, well, if you look at that, and that's one of the myths that we addressed in our recent newsletter, which is, effectively you've got, call it 850 to 900 Africa dominant companies in listed equities if you exclude South Africa. And we take that down in the first step of our investment process to say 300, which we consider investable on a liquidity basis. Now from that, in the context of the Africa Alpha Fund, we're selecting 15 to 25 stocks, which means you're only really trying to select at any point in time the top 5% of the companies, which is not onerous from a liquidity perspective at all. I think for a rational investor who's looking at Africa exposure, there's room for both private equity and listed equity in their model portfolio. But what we would point out at this stage is that if you are buying the same company in a private equity fund and a listed equity fund at a similar valuation level, you should be compensated for being locked up for 5 to 10 years in a private equity fund, whereas that's not currently the case, which is evidenced by the fact that a lot of private equity funds are actually buying listed equity stocks in Africa at the same valuations that we're buying them at in a listed equity fund.
Greg, one of the other myths that you tried to disprove in your newsletter was the fact that good economic growth leads directly to great stock market returns, and that one should potentially stay away from those economies that have lower growth expectations because it'll translate into poor stock returns. This isn't the case, as you put it.
Yeah, absolutely not. And if you look at empirical research anywhere globally, no one has been able to show this link between economic growth and stock market returns, even though it's quite intuitively appealing to think that if a country is growing faster, that you should get much higher returns on the stock market. It's only unexpected growth which can really lead to that outcome. And often you get the opposite effect where a country might be overhyped due to very high expectations of economic growth, and therefore the prices on the stock market are a lot higher, which amounts to a much more demanding entry point, whereas countries which maybe are facing some short-term economic difficulty, but you can often enter high-quality company at a significant discount. So, we provided the example of Nigeria and Tunisia, where over longer-term time period, the Tunisian market had outperformed quite dramatically against Nigeria, despite having grown at a much lower level in terms of economic growth. But you can put forward any of those case studies. There's very little link between pure economic growth and stock market returns, which effectively implies that there's very little to be gained by deciding on your stock selection from macro top-down views on country allocation.
Greg, earlier in our discussion, you referred to the importance of kicking the tires, going on the ground into these countries, so to speak, to assess the different companies and the quality of those companies. What is the general feeling when it comes to the quality of management across the continent? It's a big place. Perhaps you want to break it down geographically. Nigeria may be better than Kenya, I'm not sure. But what is your view of management when it comes to Africa? The quality of management?
I think the perception from some of the investors that we meet, whether they be in South Africa or in the US or Europe, is often that, are there sufficient high quality companies with good management teams that you can actually invest in? And that perception is completely out of touch with reality, where we see, world-class companies ahead of best international practice in terms of operating efficiency, corporate governance, and capital allocation. I think what is interesting in Africa is that you get very big gaps in quality between the high quality companies on the one hand and the lower quality companies on the other hand. But often those differences in the quality of the companies are mispriced on the stock market, which provides a great opportunity for active investors to take advantage of those mispricings. But the notion that there are no high quality companies or not enough good quality management teams to invest in is certainly not the case from our practical experience on the ground.
Greg, we're in a phase where we start talking about the deceleration of emerging markets, and in that context you've also got to look at Africa. A number of players out there saying that the African train has already left the station. Is there still opportunity, or is the best behind us when it comes to Africa?
It's amazing how much hype there is about Africa, which is not supported by actual investment inflows. So, for example, you'll pick up The Economist magazine, or you'll read sort of mainstream media reports about investment in Africa. But if you actually look, for example, at listed equity inflows into the African market, over the last 2-3 years, we've been in a net outflow environment. And what's interesting is that the marginal investor in African listed equities at the moment is actually the domestic pension funds, which are based in, let's say, Nigeria, Kenya. So it's actually local investors who are driving the markets at this stage, rather than international, who at the margin have been net sellers. So, in contrast to what you're saying about the train having left the station, I don't think that train has even arrived at the station yet.
Well, that puts it into context. Greg, thanks so much for your time. Greg Barker, Director of Investment at Sustainable Capital.